This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think.
Hey, Steve Saretsky here. Welcome back to this week's show. We got lots to touch on. We got an update on the inflation numbers here in Canada, as well as the inflation numbers in the US. Some updates from the Federal Reserve, inflation targets, what all this means for our local housing market, and of course, some anecdotal stories in terms of what we're seeing, boots on the ground. What I can tell you is it's interesting because all these data points are coming out and everyone's trying to figure out, what's the next move? When's inflation going to come down? When are rates going to come down? When should I buy a house? And this is probably one of the most complicated, complex scenarios. I was just in Vancouver doing a real estate panel with a pre-sale market research company, development company, and I was there kind of talking more on the resale market and sort of what I'm looking at in the macro side of things. There was a Scotiabank chief economist there, and I think the resounding sort of takeaway from the sort of event was one word was confusion, which is like you've got the economic numbers are all over the place. So for example, this week you had Canadian inflation data came in softer than expected, meaning inflation rolled over faster than anticipated. Core inflation down, CPI headline inflation down more than expected. Obviously, again, still elevated, but making that path lower, making that gradual path lower that obviously the Bank of Canada wants to see, especially after a couple really hot jobs numbers. So you get these hot jobs numbers, so everyone's kind of waiting for the hotter inflation numbers, and they come in lower than expected. And then on the flip side, in the same week, you get the U.S. Fed. Their inflation comes in hotter than expected. And of course, the Fed is the world's most important central bank. They basically run monetary policy for the rest of the world. So, the U.S. Fed, Jay Powell, has a metric that actually he invented, and it's called core PCE. So core PCE inflation minus core PCE services less housing services. So he tries to take out sort of the lag effect of housing, because we know that the shelter component of inflation is very lagging. So he says, let's show core PCE services less housing services. And that came in growing 0.58% month over month in January, one of the highest readings in recent memory. So this is, the last thing the Fed wants to see. And now markets right away repricing their expectations for the Fed, now calling for guaranteed rate hikes next month in March, and then 2 more coming out. So the market's expecting between another 75 to 100 basis points of rate hikes this year. So remember, over the last month, 2 months, 3 months, etc., the market has been behind the Fed. The market's saying, listen, Fed, you're going to get stopped out. You're not going to go as high as you think you need to go. Market data is going to roll over. Inflation data is going to come down faster than you expect. And now it's actually the reverse. The markets are now expecting the Fed to go higher than even the Fed is saying, projecting that they're going to have to go. So it's really interesting to see these sort of dynamics playing out. And the reality is the labor market's been relatively sticky. People are still holding on with their jobs. And if I look at what's happening, here in the housing market remains resilient. There's no inventory. Coming into this calendar year, the narrative was, listen, rates are up. We've got mortgage rates that have gone from the lows of about 1.5% to about 5.5%. Here comes the wave of foreclosures. We're going to get this dump load of new listings coming to market, and we've seen the opposite. I mean, I'd love to see the people on this channel comment below who had on their bingo card new listings coming in at 23-year lows in not only in the month of January, but we're going to see that probably again in the month of December and February. And so new listings continue to be this chronic undersupply of housing. And again, this isn't even adjusting for the rapid growth in Canada's population and in the overall housing stock over the last 2 decades. So people are just not putting their houses on the market. Again, I don't know why. Maybe there's just less stress than we know that's out there. Everyone, including myself, loves to talk about household debt to GDP, debt to disposable income ratios are going to hit new all-time highs in the next quarter or two, and so naturally you think, well, there should be a bunch of people stressing out and coming to market, and then you look at another statistic such as 50% of homeowners in the city of Vancouver, 50% of people that own their primary residence in Vancouver have zero debt. This includes a mortgage. This includes a home equity line of credit. Now, again, I understand that, people that might own their house free and clear might have an investment property that's levered up. So that doesn't factor that in. But the long and short is, you and I can sit here and banter about the macro on a weekly basis and say, hey, listen, inflation's doing this, GDP is doing that, jobs are doing this. But what I can tell you is the micro is playing out, which is demand is here and supply is here. And so you have this situation where the housing market in Vancouver, Toronto, most of Canada has actually been firming up. I've said it before in several of these videos, is the best deals that have been negotiated to date, again, could change, very well could change, assuming mortgage rates stay in the fives and we get some inventory. I would expect that to change, but to date, the best deals have been negotiated when just after Tiff Macklem dropped a bomb and raised rates by 100 basis points at his July meeting. Those were the best deals. Buyers were terrified. Sellers are like, oh my God, this could get really, really bad. And there were some really, really good deals that are negotiated. Today, boots on the ground, is you're not seeing those deals being negotiated because sellers don't have any competition. They're just holding firm. They're like, well, if I don't get this price, I just won't sell. And the reality is that if you're looking for an entry-level single-family detached house in Greater Vancouver, you're competing today. You're competing in multiple offers, 5-6 times out of 10. So it's a strange market because when you overlay the macro, you're like, well, housing again hasn't got any more affordable. Yeah, prices have come off a little bit, but arguably the cost to carry that home has become even more burdensome, and the cost of living has become even more burdensome. Yet the housing market continues to sort of hold on. So again, hard to make any predictions from personally 6 to 12 months out. I mean, I still personally think the macro is going to play out. People are talking about soft landings, no landings. We're going to have a landing. The landing might be delayed, but we're going to have a landing. And I think the landing, the likelihood is increasing that it could be a hard landing. So long as inflation is becoming sticky, it's becoming harder to get down. It's taking longer than we anticipated, which means higher for longer. And you guys know that if you know me, that have followed this channel, as the data changes, I think your opinions and your views should change. And I've been saying for the last 3, 4, 5 weeks, seeing a lot of people that are optimistic about the housing market because the rates have peaked, inflation is going to come down, and I think that thesis now is being tested. That thesis is being tested in the fact that housing has been more resilient, and the more resilient that housing is, the reality is you're going to have a higher for longer scenario. So I think people that are out there in the mortgage market, all you have to do again is go look the updated chart. The Canada 5-year bond yield touched 3.6% the day that I'm recording this. Getting back close, not quite, getting close to the highs that we saw in 2022. Mortgage rates are back above 5%. So you might have to get used to higher for longer, which is mortgage rates in the 5 handle. And so I do expect that to bring some issues into the real estate market. The reality is that low inventories are sort of papering over or supporting that or murking the reality. But we are starting to see, a rollover in national housing starts back to levels we last saw in early 2020. If you look at residential investment, that includes real estate investment in construction on the residential and the commercial side, that's rolled over now at levels last seen in basically 10 years. So we've fallen down outside of Q2 of 2020 during the depths of the pandemic. Investment in construction has pulled back to 10-year lows. You've got mortgage originations down about 37%. So I do expect the knock-on effects of that. They always say housing is the business cycle, and yes, while prices are firming up, transactions remain low because, well, there's demand is a little bit murky, and new listings, when you have new listings running at 20-year lows, there's very little turnover, very little economic activity that's happening from that. So hence the huge drop off in mortgage originations, which is when mortgage originations drop off, new credit, new demand into the system, right? Money is created into the economy through credit creation, and the bulk of that credit creation is done through new mortgage originations, and that's part of the reason why we're seeing the money supply, the monetary base, obviously roll over and dip into negative territory, something we haven't seen in several decades. So the outlook today, I will say, continues to be murky, but those betting on the transitory inflation, that rates are going to come down quicker than we anticipated, I think those hopes and dreams are starting to fade. I think that the higher for longer, the higher that we need to be, the larger the risk of a shock, of some sort of financial event. But again, we haven't had that. And I think that was part of the case for inflation coming down, right? If housing continued to be weak, if stocks continued to dump, you'd probably see some sort of financial event which would allow inflation to come down. But right now, the economy is proving to be more resilient than a lot of people, including myself, expected, and that's allowing inflation to remain higher for longer, and thus rates higher for longer. So what's going to be interesting to see is the people that are on the fringes of the credit spectrum, those that are in these short-term loans, private lenders, B lenders on, again, 1 to 2 year terms that are coming up for renewal, likely having to either renew at a higher interest rate. They'll have to renew at a higher interest rate, or because if prices, which they have compressed, if lenders get sensitive about loan to value ratios, they're going to have to put more equity into these real estate properties, and that it's going to test someone's liquidity, right? I mean, you need the liquidity to put into the property to drop that loan to value, so lenders are comfortable to lend, and that's why you're seeing some of these large commercial developers and commercial owners are getting these margin calls, right? Because their loans are coming due for renewal. Nobody wants to renew them because the loan to value ratios, the lenders are getting more conservative and saying, well, hold on, what is the loan to value? What is the value of the asset? If so few transactions are happening, you need to put another $1 million, $2 million, $3 million, $4 million into the deal, and you don't have the cash to do it. And so I continue to expect the default cycle to ramp up. The default cycle will continue the longer that we have these higher rates. The confusion in the real estate market, where you're stuck in this low transaction environment, basically creates a less liquidity in the marketplace, and so I think that default cycle will ramp up. So, like I said, watching a lot of the economic macro data, I think a lot of economists, a lot of people out there will disagree on the trajectory of inflation, of GDP, of central bank policy. I think anyone that believes they've got a firm grasp and exactly the precise outcome of how this is all going to play out, I think you're fooling yourselves. It's an extremely complicated environment. I think the volatility is going to be rather aggressive this year. And so, hey, if you're out there in the real estate market, if you're buying, selling, I think it's important to be diligent and to take on what you can reasonably handle. And we're going to see, the people that were over levered, that took on more than they could, that weren't as well capitalized, they're the ones that are going to be under pressure. So as always, hope that helped. See you next week.